This segment will discuss current liabilities. Current liabilities are amounts that are owed to others and are expected to be paid within 1 year or the company's operating cycle, whichever is longer. Amounts that are owed to others that are expected not to be paid within 1 year or the company's operating cycle, whichever is longer, are classified as long-term liabilities. Let's discuss current liabilities. There are some liabilities that involve uncertainty, and these liabilities we will be discussing later within this section. Those liabilities are uncertain as to who exactly is going to be paid, when the amount will be paid, and how much will be paid. Known liabilities are liabilities for what a company knows who will be paid, when it will be paid, and how much will be paid. Some of these we've already worked with quite a bit. Accounts payable. These are current liabilities that arise due to the normal day-to-day purchases of supplies or day-to-day expenses. We're going to look at sales taxes payable. We've talked about and worked with unearned revenues, and we'll look at another example. Short-term notes payable are another known current liability that we will look at. Payroll liabilities and multi-period known liabilities. Let's first look at sales taxes payable. On May 15th, ABC sold inventory for $7,500. Their sales are subject to a local 6% sales tax. When ABC makes the sale to the customer, the revenues that they record is $7,500, so they will credit their sales for $7,500. But they will actually receive cash of 6% more, or $7,500 times 6%, an additional $450, because the customer is paying for the inventory plus the sales tax. So the debit to cash will be $7,950. The $450 that ABC collects is a liability. They have to pay that $450 to the local tax authorities. Unearned revenues are another short-term or current known liability. On May 1st, a customer paid ABC $3,000 in advance for a service that would be provided on July 12th. On May 1st, ABC debits their cash to increase it when the cash is received. But on May 1st, they cannot record the revenues because they haven't provided the service for which the customer has paid. So they have to record a liability. That liability is called unearned service revenue, and they credit the liability. And they will keep that liability until July 12th when the service is provided. When the service is provided, they will decrease the liability with a debit, and at that time, credit the revenue. The revenue cannot be recorded until it is earned.